What is better, stocks or bonds? It is a frequently asked question among both novice and experienced investors. Today, we will explain the difference and discuss what better suits your financial goals. We will dive into the risks, rewards, and when to choose stocks or bonds. Let's get started. Let's start with stocks. When you buy a stock, you are actually buying a small piece of ownership in a company. Stocks are traded on exchanges like the AEX or NASDAQ. The advantage of stocks is that they can yield high returns over the long term. Historically, stocks have averaged a return of 7 to 10% per year. This is due to the growth of companies and the distribution of dividends. But there is also a downside. Stocks are riskier because their value can fluctuate based on market trends, company performance, and even global events. Bonds work very differently. When you buy a bond, you're lending money to a company or the government. In return, you receive interest, also known as coupon interest, and at the end of the term, you get your investment back. Bonds are often seen as a safer alternative to stocks because they are less sensitive to market volatility. Especially government bonds have a low risk. But this also means that the return is usually lower. On average, bonds yield 2 to 4% per year. They are therefore a good choice for those seeking stability and a consistent income. How do you compare the risks and rewards of stocks and bonds? Here is a summary. Stocks offer higher potential profit, but also a greater chance of loss. Bonds, on the other hand, come with lower risk, but also a lower return. The main difference lies in volatility. Stocks can rise or fall significantly within a day, while bonds usually follow a more stable pattern. This makes bonds attractive to risk-averse investors, while stocks are better suited for those willing to take risks for a higher return. Your choice depends on your financial goals, age, and risk tolerance. For example, younger investors can invest more in stocks because they have time to recover from any losses. Older investors often prefer bonds for stability and a fixed income. A smart strategy is to have a mix of both. For example, 70% stocks and 30% bonds for growth and stability. As you get older, you can shift more towards bonds. GAP 3S. Let's dive deeper into the history of stocks. Stocks have been traded for centuries, with the first stock exchange established in Amsterdam in 1602. Over the years, stock trading has evolved significantly, with the introduction of electronic trading and high-frequency trading. Understanding the history of stocks can provide valuable insights into their behavior and trends. The Amsterdam Stock Exchange was created by the Dutch East India Company to raise capital and spread risk for their voyages. This innovative approach laid the foundation for modern stock markets. Fast forward to today, we have advanced platforms like the New York Stock Exchange and NASDAQ, where billions of shares are traded daily. By studying historical trends, we can better anticipate market movements and make informed investment decisions. GAP 3S. Now, let's explore the different types of stocks. There are common stocks and preferred stocks. Common stocks give shareholders voting rights, but come with higher volatility. Preferred stocks, on the other hand, provide fixed dividends and have priority over common stocks in the event of liquidation. Each type has its own set of advantages and disadvantages. GAP 3S. Next, let's discuss the different types of bonds. Bonds can be categorized into government bonds, corporate bonds, municipal bonds, and more. Government bonds are considered the safest, while corporate bonds offer higher returns, but come with higher risk. Municipal bonds are issued by local governments and often come with tax benefits. Understanding these types can help you make informed investment decisions. GAP 3S. Now, let's take a closer look at the factors that influence stock prices. These include company performance, economic indicators, market sentiment, and global events. Company performance is often reflected in earnings reports, which can cause stock prices to rise or fall based on whether the results meet, exceed, or fall short of expectations. Economic indicators such as GDP growth, unemployment rates, and inflation can also impact stock prices, as they provide insight into the overall health of the economy. Market sentiment refers to the overall attitude of investors towards a particular market or asset. Positive sentiment can drive stock prices up, while negative sentiment can lead to declines. Lastly, global events, such as political instability, natural disasters, or pandemics, can have significant impacts on stock prices due to their potential to disrupt markets and economies. By keeping an eye on these factors, investors can make more informed decisions and potentially maximize their returns. Gap 3S. Similarly, let's explore the factors that affect bond prices. Interest rates, credit ratings, and economic conditions play a significant role in determining bond prices. When interest rates rise, bond prices typically fall, and when interest rates decline, bond prices usually increase. This inverse relationship is due to the fact that new bonds are issued with higher yields, making existing bonds with lower yields less attractive. Credit ratings are another crucial factor. Bonds issued by entities with high credit ratings are considered safer and are therefore more likely to maintain their value. Conversely, bonds from issuers with lower credit ratings are seen as riskier, which can lead to more significant price fluctuations. Lastly, economic conditions such as inflation, economic growth, and fiscal policies can impact bond prices. For example, high inflation can erode the purchasing power of future interest payments, leading to lower bond prices. By understanding these factors, investors can choose the right bonds and manage their portfolios effectively. Gap 3S. Now let's discuss some common investment strategies. For stocks, strategies like value investing, growth investing, and dividend investing are popular. Value investing involves picking stocks that appear to be undervalued in the market. Growth investing focuses on companies that are expected to grow at an above-average rate compared to other companies. Dividend investing targets companies that pay regular dividends, providing a steady income stream. For bonds, laddering and barbell strategies are commonly used. Laddering involves purchasing bonds with varying maturity dates, which helps manage interest rate risk and provides a steady stream of income. The barbell strategy, on the other hand, involves investing in short-term and long-term bonds while avoiding intermediate maturities. This approach provides liquidity with short-term bonds and higher yields with long-term bonds. Each strategy has its own set of principles and can be tailored to suit individual financial goals. By understanding these strategies, investors can make more informed decisions and better align their investments with their financial objectives. Finally, let's talk about the importance of diversification. Diversifying your portfolio by investing in a mix of stocks and bonds can help manage risk and improve returns. Rather than putting all your money into one type of asset, diversification spreads your investments across different asset classes, industries, and geographical regions. One common technique is asset allocation, which involves determining the right mix of stocks, bonds, and other assets based on your risk tolerance and investment goals. For example, a younger investor with a higher risk tolerance might have a portfolio with a higher percentage of stocks, while a more conservative investor might prefer a higher allocation to bonds. Another technique is sector diversification, which means investing in different sectors of the economy, such as technology, healthcare, and finance. This helps reduce the impact of a downturn in any one sector on your overall portfolio. Geographical diversification is also essential. By investing in both domestic and international markets, you can take advantage of growth opportunities around the world and reduce the risk associated with economic downturns in any single country. Incorporating these diversification techniques into your investment strategy can enhance your portfolio's performance and provide a smoother investment journey. Remember, the key is to regularly review and adjust your portfolio to ensure it remains aligned with your financial goals. By understanding and implementing diversification, you can better manage risk and work towards achieving your long-term financial objectives. So, what is better, stocks or bonds? The answer depends entirely on your personal situation. Both have their own advantages and disadvantages, and a balanced portfolio is often the best choice. Thank you for watching. If you want to learn more about investing and financial strategies, don't forget to subscribe, give a thumbs up, and leave your questions in the comments. See you next time.